Welcome. Today is May 4th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights Investment Strategy. And this is your Daily Five. Today, I thought we would talk a little bit about portfolio management. In the process of building a portfolio, it's preferable to own high relative strength stocks. That's stocks that are leading the market, leading their sector, and leading their industry group. So in other words, stocks that are ahead of their peers, that are outperforming. This is what portfolio managers are attempting to do all day long. They're attempting to find the stocks that are leading the market. And lo and behold, StockCharts makes it easy. Through the use of relative rotation graphs, you have the ability to scan through hundreds and hundreds of stocks and populate basically an analytical tool with names that will allow you to discern which stocks are beating the market, which stocks are beating their peer group. And the chart that you're looking at right now, our first chart of the day, really indicates how one should interpret this. And what we're looking at right now is my top 5 picks this week. And how did I arrive at these picks? Well, first of all, I screened through about 1,500 stocks, and I looked for stocks that were breaking out, that were making new all-time highs or new 52-week highs, and that were also leading in their industry groups as well as beating the market. And what I've done is I've made this easy for you. I've taken my work and put it into the relative rotation graph so that you can visually observe how these stocks are behaving. And over the past 5 weeks, we can see that all of these stocks have beaten the S&P 500 pretty handily, on average by about double. And some people might say that, well, they've had their move, it's time to take some profits. And I say, no. I say you want to buy strength. I say that stocks like Dentsply and Allstate and Post Holdings, as well as Grainger and VeriSign, have extraordinary momentum behind them. That momentum really is defined by the second derivative of relative strength. What we're looking at here is stocks that are actually beating the S&P 500 in terms of their 26-week relative strength. And that looks at those that are in the leading box in the upper right-hand corner. You're seeing both a vertical move in terms of the momentum or the strength of relative strength. In other words, the momentum of momentum. And this is pushing these stocks to greater heights in terms of their leadership. Now, let's take a look at each of these on an individual basis and try and discern from their patterns exactly what's taking place here. So our second chart of the day is Dentsply International, symbol XRAY. And what we're looking at here is about a 4-year history of price. And I've annotated price to kind of indicate what I see when I look at this chart. First of all, I look at a stock that has made a new all-time high or appears poised to challenge that all-time high from 2018. We've already seen the stock inflect bullishly above a key resistance area of a pattern-based formation. I would call this kind of a double bottom, if you will. We saw a bottom in 2018 and a separate bottom slightly lower in March of this past year, 2020. And that gave the stock really a foundation of support to build off of. And what we saw over the course of the last year is a stock that's gained strength, momentum, and also broken out from the pattern-based formation. And that pattern projects substantially higher. We can derive a profit target of 104 to the upside. So if this stock continues to sustain its upward trajectory above $60 and preferably above $69, then we believe over the next 3 to 6 months, this stock can make its way all the way to about 104. Now, just in case we're wrong about this, we want to make sure that we can manage our risk properly. So the most important part of portfolio management is really risk management. And what we want to do is we want to make sure that we're laying money on a bet that will pay off at better odds than it can lose. In other words, we're looking for a positive risk skew. And at the bottom, we indicate that the risk skew here is about 4 to 1. In other words, our upside's 4 times what our downside is. And that is kind of an optimal sort of range. Anything above 3 to 1 is a very, very attractive bet, if you will, from a portfolio management perspective. Below 3 to 1, it's a little sketchy. We really don't want to lay even money bets 1 to 1. 2 to 1's a little close for comfort. So we like to kind of optimize around 3 to 1 or better. So what else do we have in our quiver? The next chart I'd like to show you is our second favorite pick, and that's Allstate Insurance Corp. This is a stock that is emerging from a deep cup base, a base that goes back to March of 2020, those lows. We saw the stock emerge from that in what I would call kind of a bearish to bullish reversal from, a traditional cup and handle sort of pattern. But the base has continued to evolve, and we've broken out to new all-time highs yesterday and resolved above this classic pattern base formation that I'll call a deep cup base. And the stock from here projects strongly upward based on its momentum, its relative strength, and the relative strength of momentum. And we believe that the stock has potential to reach our profit target of $185, looking out about 3 to 6 months from now. Now, again, in case we're wrong, we want to kind of draw a line in the sand where we can budget the risk that we're willing to take in order to achieve that profit. And here we'll apply a stop loss at 118, which is just below its 10-week moving average, which we think will hold. That gives us a positive risk skew of 5 to 1. That's a very, very good odds bet. And so within our portfolio, we now have 2 stocks. One's a healthcare name, one's a financial name. So we're diversifying. So what do we have up our sleeve next? Chart number 4 is a staples name, a consumer name that gives us further diversification in terms of sector and also in terms of pattern and progression. Post again made a new all-time high yesterday. It has resolved above kind of this deep cup base again, but we've seen it move in kind of a stair-step fashion. And we believe that now that we've cleared this upper boundary of resistance, there's really no more supply to come into play. There are no unhappy shareholders of Post Holdings today. Meanwhile, we see relative strength accelerating and strong momentum behind that relative strength. The pattern projects to $155 if successful, and we've set our stop loss at 103, which is well below the 10-week moving average and around the prior level of resistance, which should now become support. And so we believe that the stock will hold up above this threshold that it's just penetrated and make a move all the way to about 155 over the next, say, 1 to 4 months, in our opinion. And so based on this, we have a positive risk skew of 3 to 1, which is right in our wheelhouse. So let's see what we can diversify into next. The next chart I want to show you is a better look at Grainger. Now, Grainger's a more advanced move. We've seen the stock break out some time ago, really last summer, from a traditional sort of deep base sort of variety of pattern. But what's interesting is the breakout needed to consolidate. And so once we got up to around the 420 range, we saw a pullback that held above prior resistance, which became support. And that has now reversed and broken out as well. Now, the stock's actually pretty strong today in a weak tape, which gives us a lot of confidence. The only problem I really see with this name is that the risk skew is not quite as positive as we would like. It only shows up at this point at about 2 to 1. The stock's trading, last I looked, around 450. It closed out yesterday at 443. So the incremental strength is taking away from, that risk reward skew that we like to see, better than 3-to-1. We're now only around 2-to-1. But if the stock works out, and I would actually look to maybe wait for a bit of a pullback here, see if the stock can consolidate back below that 443 level that we saw yesterday. And if we can own the stock closer to its breakout level, that would be optimal. And then we could reduce our downside risk and improve our risk skew to something greater than 3-to-1. So, we're buyers of Grainger on a pullback as long as it holds above 425. And we think that the stock has the potential then to get to 500, and we'd set our stop loss at 410. Under those conditions, we'd have something better than that 2-to-1 positive risk skew, closer to 3-to-1 where we want to be. The final chart I'd like to show you, and apologize, I went with 6 charts today instead of 5, but this one's really important. I think VeriSign is probably the best opportunity of the 5 stocks I presented. And the reason I think that, not because it's leading, it's actually furthest away from relative strength leadership in terms of its 26-week relative strength, but it's got the strongest momentum and it's really improving. And in my opinion, I think that we could see VeriSign turn into a big leader. I like the fact that the stock has broken out and made a new 52-week high and a new all-time high yesterday as well. So, we've resolved above this classic pattern-based formation of the inverted head and shoulders variety, which is one that has a high probability of resolving up. We've seen this improvement in relative strength, as I mentioned, the strong momentum in relative strength, which gives us confidence that the stock is going to attract the attention of the buy side, as portfolio managers need to buy outperforming stocks in order to beat their benchmarks. And this is how they're going to do it. Our pattern recognition gives us insight into the upside of the stock by projecting the depth of that head portion of the pattern above the neckline to come up with a profit target of 290. We believe that 290 can be achieved sometime in the next 3 to 6 months. It's a bigger pattern, so it might take a little longer to resolve favorably. We want to set our stop loss at around 205, which sets up a very nice 4-to-1 positive risk skew. We like giving ourselves good breathing room here, but not so much that we're going to take a fairly or too large of a hit if we're wrong, if the pattern fails. We think the pattern looks good. We think the relative strength looks good. So that sums up our portfolio for today. If you'd like to get some more information about the work that we're doing, you can always follow me on my website. It's jwhinvestment.com. You can also find us on Twitter at Alpha Insights. We're also on the Trade Exchange and Nucleus 195 for institutional investors. And of course, you can find us on LinkedIn, where we publish a variety of interesting articles and insights from time to time. Thanks a lot for your time today.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.